Welcome back to the Deep Dive. You've provided us with a stack of fascinating sources, detailed research, and analyst notes, and today we're diving into one of the most volatile sectors in technology.
Absolutely. We're talking about a sector that's historically been defined by these breathtaking highs and, well, catastrophic lows. We're talking about semiconductor memory.
That's the perfect way to frame it. For decades, if you were involved in the DRAM or NAND flash market, you were basically just riding the infamous boom and bust cycle.
Oh, it was a brutal pattern and
Yeah.
so predictable. Demand would tick up just a little, everyone would panic and build these massive new fabs, and then inevitably the market would flood.
And prices would just crater.
Right.
Along with every investor's portfolio, it was agonizingly cyclical.
Yeah.
But our source material today suggests that this historical gravity might finally be breaking.
Yeah.
Specifically for Micron technology, ticker MU.
Mm-hmm. The consensus among these analysts is that Micron is undergoing what they call a profound structural transformation.
And this isn't just a high point in the cycle. They're actually labeling it a bona fide AI-driven supercycle, one that seems to be fundamentally rewriting the economic rules of memory.
And that, right there, that's the core intellectual challenge of this deep dive.
Right.
Our mission is to unpack all this material to understand why this shift is structural, not just, another temporary high. We need to analyze how Micron is using technology and geopolitics to build a new, formidable competitive moat.
And we absolutely have to identify the massive risks that are still lurking on the horizon. I mean, especially as we look out towards, say, 2027 and beyond.
For sure.
I think we need to establish the initial core takeaway right here at the top, because it really governs the entire discussion.
Okay.
Micron is transitioning. It's moving from being, a provider of commoditized products where price is the only thing that matters.
To becoming an indispensable, critical infrastructure enabler.
Exactly. For the entire global AI ecosystem. That is a philosophical and, more importantly, a financial shift that demands our immediate attention.
Couldn't agree more.
So let's unpack this with Section 1, the new economics of AI memory.
All right, so we have to start with the main thesis from the research, which is this idea of a structural decoupling.
Decoupling from what, exactly?
From history, basically. To understand why this cycle is different, you have to remember how memory worked for the last, 40 years?
It was all fungible.
It was all fungible. DRAM capacity was interchangeable. If PC demand was high, you cranked out DDR chips. If server demand was high, you switched over and cranked out server memory.
You could pivot capacity really easily.
Really easily, which meant any increase in demand was almost instantly met by a flood of new supply, which inevitably triggered those vicious price wars we mentioned.
And Micron, like its competitors, just chased volume above all else. They often destroyed shareholder value in the process.
They did, but the AI era has just utterly shattered that fungibility.
How so?
The sources all point to the convergence of two non-negotiable factors. The first is the extreme scarcity of high bandwidth memory, or HBM.
And the second?
And the second is what the industry calls the memory wall in accelerated computing.
The memory wall. Let's break that down. What is that?
It's a fundamental physics problem. Modern AI accelerators, specifically the high-end GPUs from companies like NVIDIA, are just achieving speeds that are so far beyond previous generations
That the old memory interfaces can't keep up.
they can't feed the processor fast enough. Imagine the processor is this insatiable engine. Standard memory is trying to feed it data through a straw. It's completely bottlenecked.
Okay, so the bandwidth required to train these massive foundation models is just enormous.
That's staggering. And this brings us directly to HBM.
Which solves this problem.
It solves this problem by integrating the memory directly onto the same substrate as the GPU. It creates all these parallel pathways for data.
So it's the difference between drinking through that one straw and, opening up a dozen fire hoses at the same time.
That's a great analogy. And this absolute non-negotiable requirement for massive bandwidth, that's what makes HBM the critical bottleneck in the entire AI infrastructure build-out.
If a hyperscaler can't get their hands on HBM, they simply can't build an AI cluster.
Full stop. It's that simple. And so the power dynamic shifts decisively.
From the buyer.
The colossal spending giants, like Microsoft, Google, Meta to the supplier.
Micron, SK Hynix, and Samsung.
Yep. They're now the ones controlling the flow of the most critical resource in the world's biggest technology build-out.
Okay, let's drill down into the physics of this scarcity, because this is the section that I feel often gets glossed over. But it's the structural underpinning of the whole investment thesis. We need to talk about the bit penalty.
This cannot be overstated. When we look at the raw cost of production, it's not just a little bit more expensive to make HBM. It is structurally profoundly more difficult.
And the source material emphasizes a very specific ratio.
It does. The critical ratio is this. Producing one single bit of HBM requires approximately 3 times the raw wafer capacity of standard DDR5 DRAM.
3 times. That penalty, the 3x capacity drain, is what we need to explain fully to everyone listening. Why is the cost so high? I mean, if a bit is a bit, why does HBM consume so much more silicon?
It's a combination of size and complexity, and then that's compounded by yield loss.
Okay, start with size.
First, HBM modules require physically larger, more sophisticated die sizes than traditional commodity memory. They have to incorporate all this necessary interface logic.
But that's not the whole story.
Not at all. The real culprit is the manufacturing process itself. It's the complex through silicon via or TSV stacking.
Right, TSV stacking. This is where they're literally drilling these microscopic vertical tunnels through the silicon wafers to connect the different layers of the memory chips.
Precisely. You're not just printing circuits on a flat surface anymore. You are performing an extremely precise 3D engineering operation.
And these stacks are getting bigger.
They are. HBM stacks typically involve 8 layers or even 12 layers of memory chips now. Each one of those layers has to be perfectly aligned, and the thousands of TSVs must connect seamlessly. This introduces 2 major yield challenges.
Okay, what's the first one?
First is something called known good die, or KGD testing.
Known good die.
You have to test every single memory die before you stack it. Because if you stack just a single bad die in an 8-layer or 12-layer stack,
The entire stack is ruined.
the whole thing, this incredibly expensive component, is just garbage. And it's far, far more difficult to test a die to HBM standards than a standard flat die.
And the second challenge.
The second is the physical process yield loss. Just the act of drilling the TSVs, thinning the wafers down so you can stack them, and then bonding them together,
Right.
it all introduces inherent stresses and failure points.
So the percentage of usable stacks you get from any given wafer is just much lower than with simple DDR production.
Significantly lower.
So if you factor in the larger dies, the KGD testing requirements, and the massive yield loss from the stacking process, you get to that 3x number.
The math works out. For every 3 units of raw silicon wafer capacity Micron sends into the HBM production line, they get only the equivalent of 1 unit of standard DDR5 output. The 3x penalty is locked in by physics.
That physics problem is the key to this whole margin floor discussion we're about to have.
It is. Now, let's connect that penalty to the structural restriction of supply. If Micron is dedicating a massive, and more importantly, an increasing amount of its wafer capacity to making HBM.
Which is the most profitable product in the history of memory.
Right. So what happens to the supply of standard DRAM for consumer products?
Yeah.
For PCs, for phones?
It's physically starved. This is capacity cannibalization in action.
That's the term. By dedicating a wafer to the complex yield-reducing HBM process, Micron is structurally unable to produce that same volume of standard commodity chips.
And this structural restriction, this is the critical insight that breaks the traditional cycle.
Exactly. Even if the consumer PC or mobile phone market is weak, which historically was a guarantee for a massive memory crash, if the AI market is booming, Micron's decision to prioritize HBM inherently limits the supply of everything else.
So the cyclical downturn mechanism is broken, at least for now. Let's question it. It's an inadvertent shortage in commodity chips, but it creates an artificial yet incredibly strong pricing floor.
Right. It supports gross margins across Micron's entire portfolio, even if demand in those non-AI segments is just, tepid. The HBM supercycle acts as a structural anchor for DDR5 pricing.
It's the ultimate hedge.
It really is. And this leads us to a data point that is genuinely astonishing, especially if you know the history of this industry: rare revenue visibility.
Yeah, this part of the research was incredible.
Our sources confirm that Micron's HBM capacity is fully allocated, meaning it's already sold via contract through the entirety of calendar year 2026.
And it's largely committed for 2027.
And largely committed for 2027.
Wait, 2 to 3 years of contracted sales?
Yeah.
In the memory business, that is completely unheard of.
It is. In previous cycles, visibility was measured quarter to quarter, maybe. When the market peaked, companies were still just guessing what demand would look like 6 months out.
It was an instant game.
Purely. This long-term contracting ability fundamentally de-risks Micron's entire revenue profile. It provides a stable base of high-margin income that previous memory companies could only dream of.
And it also justifies the massive multi-billion-dollar capital expenditure plans we're going to discuss later.
Absolutely. Because they know the demand for the resulting capacity is already locked in.
It truly changes the financial DNA of the company. It's like they've moved from selling, I don't know, raw oil on a daily spot market to selling bespoke, custom-refined jet fuel under multi-year, fixed-price defense contracts.
The business model has shifted from volume speculation to infrastructure provisioning.
The jet fuel comparison is perfect because of the specialized nature of the product.
It is. And that specialization brings us directly to our next section, how Micron actually engineered this position by moving beyond just competing on scale.
Right. Section 2. Building the moat through technology and product differentiation.
For the longest time, the memory industry mantra was just economies of scale.
Be the lowest cost producer. That was the whole game.
That was the entire game. But now, the competitive advantage has shifted completely to process leadership and product differentiation, especially in that specialized tier of HBM and high-capacity data center SSDs.
This strategic pivot was absolutely crucial.
It was. Management realized that competing on price with commodity parts was just a race to the bottom. The future lay in solving the most challenging technical obstacles for the world's biggest spenders, the hyperscalers, where efficiency, not upfront cost, is the primary concern.
Let's focus on the HBM differentiation then, specifically their HBM3E product. We've established that AI clusters need bandwidth, but what's the technical metric that makes a hyperscaler choose one supplier's HBM over another's?
It's overwhelmingly power consumption.
Yeah.
Power. AI data centers are immensely capital intensive, but their real constraint is heat dissipation and available electricity. They hit thermal and power limits long before they run out of physical space. Every single watt saved is absolutely critical.
And this is where Micron secured a massive quantifiable advantage.
It is. Our sources highlight that Micron's 12-layer HBM3E stack offers a significant 20% to 30% reduction in power consumption compared to its primary competitors, Samsung and SK Hynix.
20 to 30%. Let's put that in context.
Well, think about what that means when you are deploying tens of thousands of GPUs, each with multiple HBM stacks. That power efficiency doesn't just save a few dollars on the electricity bill. It translates directly into millions, possibly hundreds of millions of dollars in operational expenditure savings over the lifespan of a data center.
So the total cost of ownership, the TCO argument, becomes incredibly compelling.
That's the term they use.
Even if Micron's HBM module costs, say, 10% more upfront than a competitor's chip, the TCO calculation means Micron's product is actually cheaper because it saves so much more money on electricity and cooling infrastructure over 5 years.
Exactly right. And this is the source of Micron's incredible pricing power. They don't have to compete on the cheapest price. They compete on the best TCO solution,
Which lets them command a premium.
a high-margin premium for their product simply because it makes the customer's entire massive infrastructure run more economically.
Now, in terms of the competitive landscape, we have to keep things in perspective. SK Hynix has been the trailblazer here.
Oh, for sure. They remain the volume leader, currently holding between 52% and 60% of the HBM market, largely thanks to their early and very deep relationship with NVIDIA.
That's the baseline.
That's the baseline. However, Micron's progress in gaining traction has been, well, truly dramatic. They currently hold approximately 21% to 25% of the HBM market.
Which is a massive jump from prior generations.
A huge jump. And crucially, the sources specify that Micron achieved this position by successfully displacing Samsung in key NVIDIA qualification cycles for their high-end HBM3E products.
That is a tectonic shift in the industry. It means Micron is no longer the third player struggling for scraps. By securing that 20–25% slice, they have established themselves as the critical second source.
And for a company like NVIDIA, or for a massive hyperscaler, having a qualified second source is non-negotiable. It's all about supply chain resilience.
It mitigates risk.
Totally. If the volume leader SK Hynix runs into some kind of manufacturing issue, the customer has to have a backup. Micron has proven its technology leadership, they've secured that position, and they've effectively locked Samsung out of some critical, immediate revenue streams.
Okay, moving from the product advantage to the manufacturing process itself. Let's discuss process node leadership. Success in memory manufacturing is always about executing the transition to the next, denser, and more cost-effective manufacturing node.
Right, and here we're talking about the 1 gamma leap.
Before we get to 1 gamma, let's look back at 1 beta. That success provides some important context.
It really did. Micron achieved volume production on the 1 beta node without using extreme ultraviolet or EUV lithography. They relied on some very advanced multi-patterning techniques instead.
And that was a very intelligent risk mitigation strategy at the time, wasn't it?
It was a brilliant move in hindsight. Early adoption of EUV was plagued by high costs and massive yield issues for some of their rivals. By waiting, Micron reached yield maturity faster with 1 beta, securing volume and revenue while others struggled.
But now, with the 1 gamma node, they are finally incorporating EUV lithography for the first time.
They are, and this first-time EUV adoption is yielding massive technical results.
What are the 2 key performance indicators the sources are highlighting for 1 gamma?
2 things that really strengthen their moat. First, it delivers a greater than 30% improvement in bit density.
So they're cramming 30% more memory bits onto the same wafer area.
Right, which drives down the unit cost for all the memory they produce on that node. And second, they achieve over a 20% power reduction compared to their previous 1 beta node.
So they're maintaining that critical power efficiency lead in HBM.
Exactly.
So their decision to wait for the EUV tool ecosystem to mature before jumping in, it really looks like an optimal execution strategy. And this timing seems to have created what the analysts call an execution gap with their key rival.
This is the competitive intelligence that really differentiates this source material. Reports indicate that Samsung has been struggling pretty significantly with yields on their comparable next-generation nodes.
Really?
These struggles have apparently required substantial redesigns and, critically, have significantly delayed their HBM3E qualification with those key customers, like NVIDIA.
That delay is a direct financial gift to Micron.
It's a huge gift. While Micron is ramping production, locking in these contracts through 2026, and delivering power-efficient product, Samsung is stuck managing yield issues and redesigning chips. It's a temporary but very potent competitive shield.
It cemented their position as that crucial second source.
It allowed them to monetize the current AI gold rush fully, while Samsung, the largest memory player in the world, is stuck playing catch-up.
Before we move on to the finances, we absolutely have to address the other 30% of their revenue. NAND flash.
Right, DRAM is the headline star right now, but NAND provides the necessary high-speed, high-capacity storage for the massive data lakes needed for AI training and inference. It's the hidden engine of the AI infrastructure.
And here, too, Micron seems to maintain a technological lead.
They do. They were the first to achieve volume production of 232-layer 3D NAND. And this was accomplished using a revolutionary architecture called CMOS under array, or CUA.
CUA, that's a critical technical detail. What does that architecture mean in simple terms?
Well, traditionally, the logic circuit, the CMOS, and the memory array sit side by side or on top of each other in a less efficient way.
Okay.
CUA allows them to stack the logic controller under the actual memory cell array,
Which saves space.
It dramatically reduces the chip footprint and complexity, leading to industry-leading areal density, more bits per square millimeter.
And that technological superiority immediately translated into market validation.
It did. That density enabled their high-end 6500 Ion series SSDs, and our sources show this product line secured the #2 market share position in data center SSDs for the first time ever.
Which is just confirmation that the specialized product strategy is working across the board, not just in DRAM.
Right. Micron is proving its ability to capture value in sophisticated integrated storage products, the enterprise SSD or ESD market, where margins are far, far higher than in commodity SSDs.
So we've established the physics of the scarcity with the bit penalty and the technical moat with HBM3E efficiency and 1 gamma execution.
Right.
Now, let's see the financial proof of this supercycle.
If the analysis so far is convincing, the financial data is where the rubber truly meets the road. This section really proves the magnitude of this structural shift. Fiscal year 2025 was a watershed moment for Micron.
It was record-breaking by almost any measure. Revenue reached $37.38 billion for FY 2025. That represents a 49% increase year over year.
Which is already huge. But what's more compelling is that the momentum didn't just maintain, it accelerated significantly.
It did. Heading into Q1 of fiscal year 2026, revenue surged to $13.64 billion. That's up an astonishing 57% year over year.
This momentum just confirms the demand environment is not just rebounding, but it's actively compounding.
And look at the future guidance for Q2 FY 2026 management projects, revenue around $18.7 billion.
Right, and if you take that run rate and annualize it, You were approaching a previously unimaginable figure, $75 billion in revenue.
Just to put that in context, their peak revenue in the last significant boom was so much lower. This is growth at an unprecedented scale and speed.
And that growth is entirely fueled by the mix shift. The data center business unit has replaced the volatile consumer segments as the main driver. It now accounts for over 50% of total revenue.
And the sources specifically highlight the explosive growth in HBM.
They do. It reached nearly $2 billion in Q4 of FY 2025 alone. That implies an annualized run rate of $8 billion for a single product line that, barely existed commercially 5 years ago.
But the most striking evidence of this supercycle, and the true indicator of their newfound pricing power, is the gross margin profile. We are witnessing a true margin shockwave.
The historical volatility of memory meant margins could swing from, say, the high 40s at a peak all the way down to negative margins at the trough.
And for context, during the last severe downturn just 2 years ago, Micron's gross margins were in the low teens or even single digits.
It was brutal, yet they just had a non-GAAP gross margin of 56.8% in Q1 FY 2026. That is already peak cycle profitability.
But here's the shocker.
This is the crazy part. The guidance for Q2 FY 2026 suggests margins will accelerate further, exceeding 67% to 68%. For a capital-intensive memory company, that figure is utterly revolutionary. It just redefines what profitability means in this industry.
And we have to contextualize that 67% plus margin projection.
Please do.
When people talk about the gold standard in the global semiconductor landscape, the company everyone measures themselves against is Taiwan Semiconductor Manufacturing Company, TSMC.
The best in the world.
Their world-class logic foundry operates with gross margins, typically in the 53% to 60% range.
Right, which is considered phenomenal.
So for Micron to project margins surpassing 67%, putting them decisively ahead of the world's premier logic foundry, is the ultimate financial proof of extreme market scarcity and overwhelming pricing power.
It shows that the bit penalty is so severely restricting supply that customers are paying whatever is necessary. It allows Micron to dictate terms and achieve margins previously reserved only for, IP companies, not manufacturers.
And this immediately translated to the bottom line, with Q1 FY 2026 GAAP net income reaching $5.24 billion.
A massive number.
Let's shift the perspective to the investors and talk about return on capital. When a company is spending billions on capacity, this is the metric that proves whether that spending is actually creating value for shareholders.
Absolutely crucial metric. After that cyclical trough, the return on invested capital, or ROIC, has recovered sharply. The sources show the trailing 12-month ROIC is now standing near 18.70% to 19.93%.
And for a capital-intensive business with Micron's debt and equity structure, the weighted average cost of capital, the WACC, is generally estimated around 10% to 11%.
So when your ROIC is nearly double your WACC, you are generating massive economic value added, or EVA.
So every dollar they deploy is efficiently generating high returns.
It is. This is the ultimate validation of their specialized product strategy. They've finally solved the fundamental problem of the memory industry, which was generating consistent, high returns on the huge amounts of capital required for the next generation of chips.
And to fund that generational capital deployment, they need an ironclad balance sheet.
And they have one. As of Q1 FY 2026, Micron held $12.0 billion in cash and marketable investments. And crucially, their leverage profile is low, with a total debt-to-equity ratio of just 0.28.
That significant liquidity buffer is absolutely essential for funding the massive strategic bet they are making over the next 5 years.
It is. Which brings us to the next section.
Section 4, the $200 billion strategic bet and the geopolitical moat.
That robust balance sheet is being put to work immediately. We are entering a phase of what these analysts are calling the CapEx supercycle, defined by massive, aggressive strategic investment.
The headline number is just staggering.
Uh,
A $200 billion long-term investment plan.
And in the near term, the spending is immediate and aggressive. For FY 2026, CapEx is projected to hit $20 billion. That's a 45% increase year over year.
The natural reaction to a $20 billion CapEx number in the memory industry is panic.
Total panic. Historically, massive CapEx is the leading indicator of a looming bust.
But we've established that this time the spend is highly strategic. So where specifically is this $20 billion going?
The allocation breaks down into 3 strategic buckets. First, a large portion is dedicated to HBM conversion. This means acquiring specialized through-silicon via TSV tools and expanding advanced packaging capacity in their existing facilities in places like Singapore and Taiwan. This spend is aimed directly at relieving the HBM supply bottleneck that is currently constraining their revenue potential.
Bucket number 2.
Second, we have domestic R&D investment. This is things like the new R&D fab in Boise, Idaho, which will be the hub for developing those future nodes like HBM4 and the 1-gamma successors. That's for long-term technology leadership.
And third, the massive Greenfield project.
The $100 billion New York megafab in Clay, New York. We have to pause here because our sources state this is slated to be the largest private investment in New York State history.
That number alone just speaks volumes about the priority and scale of this commitment.
It's not just a business decision. It's a statement of national strategic intent.
Okay, but let's go back to the bear case for a second. High CapEx usually precedes a crash. How does the current analysis counter this ingrained fear?
By understanding the quality of the spend. The key difference is that the money is allocated to highly specialized capacity.
Right.
The greenfield construction secures future capacity, but it doesn't immediately flood the market with chips. And the specialized HBM conversion equipment, the TSV bonders, and testing tools, they cannot simply be used to churn out commodity DDR5 DRAM.
So because the investment is specialized, it structurally mitigates the risk of instantly creating massive oversupply in the commodity market.
Which is what usually triggers the cyclical crash. It's capacity for AI, not capacity for commodity.
Precisely. And this leads us to the geopolitical moat, which is a massive source of funding and a competitive advantage that its South Korean rivals just cannot replicate.
It's a huge deal. Micron holds this unique status. It is the only U.S.-based manufacturer of leading-edge memory. In the current geopolitical environment, this instantly positions it as a strategic national security asset.
So the government support is explicit and substantial.
It is. They're receiving over $6.1 billion in direct grants via the CHTS Act.
Plus, the lucrative 25% investment tax credit, the ITC, on qualifying expenditures.
Yeah. That government intervention fundamentally lowers Micron's effective cost of capital for these massive U.S.-based projects. It makes the Clay megafab financially viable when, purely based on labor and operating costs. It might have been cheaper to build elsewhere in Asia.
And beyond the direct money, there's a crucial strategic advantage with the customer base.
Right. U.S. hyperscalers and increasingly government contractors and defense organizations are prioritizing supply chain resilience and geographical diversification. They need to buy from a reliable, domestically secure supplier.
This dynamic suggests Micron can potentially command a security premium in its pricing.
Or in volume allocation from its U.S. government and defense-adjacent customers. That layer of secure, high-margin revenue partially insulates this stream from the volatility of the global spot market.
It creates a captive customer base willing to pay a slight premium for security and reliability. That's a powerful moat.
It is.
Now, let's address capital allocation constraints, which is vital for the investor audience. Micron pays a symbolic dividend, but share repurchases have been notably modest, if not paused entirely.
And that's despite the massive expected increase in future cash flow.
Right. So why is that?
Well, management's priority is liquidity and CapEx funding that massive $20 billion spend in FY 2026. But there's a critical regulatory layer here. The T-Chip EPS Act funding imposes strict guardrails from the Department of Commerce.
Specifically, what are those guardrails and why do they affect buybacks?
They explicitly restrict the use of grant funds for enhancing shareholder returns through buybacks or substantial dividend increases.
I see.
The government subsidy is intended for building domestic capacity and technology, not for financial engineering. And furthermore, the grants often impose restrictions that limit buybacks for a period of several years after the funds are distributed.
So the message to shareholders is clear. Growth, capacity expansion, and technology leadership are the absolute, unequivocal priority for the immediate future.
Yep. Massive buyback programs, while they might be financially tempting with these high earnings, are structurally off the table due to the geopolitical funding they rely on.
Got it. Okay, Section 5, the road ahead, HBM4, Edge AI, and the risks.
So we've established the supercycle is real and profitable now. Let's look at the future legs of growth that Micron is betting on, and, crucially, the threats that could still derail this whole narrative. The next major transition is to HBM4, which Micron expects to ramp between 2026 and 2027.
And HBM4 is a significant technical leap. It doubles the interface width from the 1024-bit interface of HBM3E to a 2048-bit interface.
Basically doubling the data pipes and the available bandwidth. But the most transformative change is what the sources are dubbing foundryfication.
Foundryfication, what does that mean?
It means that with HBM4, the base die, the foundation of the memory stack, moves to a specialized logic process, often provided by a semiconductor foundry.
So instead of being just a simple interconnect, the base die becomes a sophisticated piece of logic itself, customized for the specific needs of the AI accelerator it's connecting to.
Exactly, like for a custom CPU or a specialized ASIC. Think of it this way. In the past, you bought a standard memory engine block. Now you're having a finely tuned custom engine block built specifically for your unique race car.
So this base die will contain specialized logic customized for specific platforms, whether it's Google's TPUs, Amazon's Trainium, or future NVIDIA architectures.
Precisely. And this requires deep technical collaboration, forcing Micron to partner very closely with logic foundries.
Which is where their relationship with TSMC becomes critical.
It's a critical asset. Working closely with TSMC ensures that Micron's custom HBM stacks integrate seamlessly into the most advanced GPU packaging flows, like TSMC's CoWoS technology.
And this transition to custom HBM creates two huge advantages for Micron.
Two big ones. Higher margins because they're selling a tailored solution, and stickier customer relationships because that memory is now inextricably linked to the customer's proprietary processor architecture.
Okay, moving away from the data center, the other massive volume driver that validates the supercycle is the edge AI wave, AI running locally on consumer devices.
This represents the volume return for the memory industry, but at density requirements that just dwarf previous cycles. We aren't talking about 8-gigabyte laptops anymore.
No. AI-enabled PCs like Microsoft's Copilot Plus PCs require a minimum of 16 gigs of RAM. And 32 gigs is quickly becoming the standard floor for optimal performance.
Today, smartphones need 12 to 24 gigs of LPDDR5X to run these large language models locally.
And Micron is pioneering key innovations here, too. The sources mention the LPCAIM M2 laptop memory form factor.
Yeah, which integrates memory directly onto a motherboard substitute. This saves space and significantly improves power efficiency in slim laptops, positioning them perfectly for that 2026-2027 upgrade cycle when these AI PCs become mainstream.
And here's a critical full circle moment where that bit penalty we talked about reasserts itself in the consumer market.
It does. The massive capacity cannibalization required for HBM production is actually starving the PC and mobile markets of standard DRAM supply.
So the AI boom isn't just making Micron rich in HBM, it's raising the price floor for their legacy products by causing an artificial shortage.
Exactly. Some IDC analysts are warning that the PC market, which is seeing renewed demand, might actually shrink in 2026, not due to lack of consumer interest, but purely due to component shortages and the resulting price hikes for memory and storage.
This involuntary reduction in supply benefits Micron's average selling prices, their ASPs, in their commodity segment.
Which further reinforces that structural margin floor we discussed earlier.
We've painted a picture of technological dominance and financial success, but a deep dive requires us to fully vet the bear case. We have to pivot to the major downside risks, because memory is memory, and history has a long, painful memory.
It certainly does. And the single biggest, most existential long-term threat is the cobweb cycle, which is projected for 2027 and beyond.
Explain.
The high prices and astronomical margins we just discussed are inevitably attracting massive industry-wide capital expenditure. That $20 billion Micron CapEx plan is being mirrored by SK Hynix and Samsung.
And the fear is that if AI demand, particularly from the hyperscalers, slows down its exponential build-out, or if the actual monetization of AI lags expectations,
then the flood of new HBM and specialized capacity slated to come online in 2027 could crash prices right back to the historical lows.
it's a supply-side risk triggered by exuberant spending.
It is. And the wild card that could trigger this sooner is Samsung's resurgence. They're the world's largest memory producer, and they are fiercely motivated to solve their current production issues.
If Samsung solves those reported yield struggles on its comparable next-gen nodes and successfully qualifies its HBM3E with NVIDIA, the immediate impact would be massive.
It would flood the market with high-volume supply, likely in late 2026 or early 2027. And this would immediately cause the scarcity premiums that Micron and SK Hynix currently enjoy to just evaporate.
Samsung, returning to full strength, instantly breaks the supply discipline that is currently underpinning Micron's 67% margins.
It's a huge risk.
We also have the looming geopolitical and China threat. We celebrated the U.S. Xi Jinping Act support, but subsidized international competition remains a factor, particularly in legacy nodes.
Absolutely. The domestic Chinese competitors, CXMT in DRAM and YMTC in NAND, are expanding capacity aggressively in legacy nodes like DDR4, backed by significant state subsidies. They don't have to operate under the same capitalist profit motives.
So while Micron is focused on high-margin HBM, the Chinese state-subsidized memory could flood the low-end DDR4 market, creating massive pricing pressure.
And that's the subtle but dangerous threat. This influx of cheap, subsidized memory could force Micron to effectively abandon the low-end DDR4 products entirely. And while they want to focus on the high end, losing volume in the low end reduces overhead absorption and eliminates a steady source of cash flow that historically helped fund R&D.
Finally, we have to look at the classic risk in semiconductor investing: valuation compression.
Right. The sources mention the memory paradox, which suggests the stock price often peaks before earnings do.
This is a psychological and market efficiency risk.
It is. Investors are forward-looking. They can already see the peak of earnings, which analyst project could deliver around $30 in EPS for FY 2026. If the market believes this boom will inevitably end in 2027 or 2028, it will refuse to pay a high PE multiple for those peak earnings.
So if the stock is currently trading at, say, 10.5x forward earnings, but the market price is in the cyclical peak, by compressing the multiple down to 5x or 6x, which is historically common for memory troughs, the stock price could stagnate or even decline.
Even if Micron delivers those record $30 EPS numbers, the valuation debate is absolutely critical.
It really is.
Okay, let's bring this all together for you, the learner. Our deep dive confirms that Micron technology has executed a stunning metamorphosis. It has moved from being a volatile, cyclical commodity producer to what appears to be a secular AI technology leader.
And the shift is driven by three irreversible forces. First, HBM scarcity, backed by that structural 3x bit penalty.
Second, decisive process leadership through superior execution on the 1-gamma node and that all-important power efficiency.
And third, the robust geopolitical moats secured by the Sheech I ticked.
The financial proof is just undeniable, with projected margins surpassing 67%, demonstrating a pricing power never before seen in the sector. The near term is secured by long-term contracts extending through 2026 and into 2027.
Which dramatically alters the company's risk profile and justifies those aggressive strategic investments.
It does. But the risks, the cobweb cycle, the potential for Samsung's resurgence, and the classic memory paradox of valuation compression are massive.
So, based on our source material, here are the three specific monitorables you should track to gauge the durability of this supercycle.
First, watch Samsung's HBM qualification status with NVIDIA. Any success for Samsung is a direct, immediate threat to Micron's scarcity premium.
Second, monitor Micron's HBM4 ramp execution. The successful transition to that custom HBM required by foundrification and their collaboration with TSMC is vital for maintaining margins post-2026.
And third, keep a constant watch on the quality of CapEx discipline. We need absolute certainty that the $20 billion budget is truly focused only on specialized HBM conversion and greenfield construction capacity that structurally avoids producing commodity chips.
Versus any signs of undisciplined spending on legacy capacity, which would signal a return to the bad old days of the cycle.
Exactly. As we mentioned, our analysis shows Micron is currently trading at approximately 10.5x forward FY 2026 earnings. If the market still sees them as a cyclical stock, that multiple is likely fair, perhaps even a bit stretched.
But the final provocative question for you is this. If the market ultimately agrees that HBM has truly provided a structural, permanent floor for profitability, if they believe Micron is now an indispensable AI infrastructure player rather than just a commodity chip maker, the PE multiple could permanently re-rate to 15x or even 20x.
So, the key debate hinges on one specific physical reality we discussed at the start. Is the physics of the bit penalty, that unyielding 3x capacity constraint required for HBM production, is it strong enough to permanently override the 40-year history of the cyclical memory industry?
That physical constraint versus financial history, that's the battle defining Micron's future. That's the deep dive for today. Thank you for joining us as we unpack the structural metamorphosis of memory. We'll see you next time.